The world is suffering from an energy crisis. Both Americans and Europeans are feeling their pockets starting to get squeezed. At the same time, some companies in the energy sector are making a killing and their cash positions are bubbling up tremendously. By buying such companies, anyone might profit and make above average returns. In this video, we go through a rundown of the most secure and profitable companies in the sector, as well as we run through multiple data which showcases how the US is gaining advantage and market share in the global energy sector. It is best for us to start off with a brief rundown of the main causes for the current global energy crisis. A major cause is the decades-long lack of investments in capital expenditures in the sector. This has made the market very inefficient in terms of new supply, which can be brought to market. Also, the two big ambitions for a zero-emission future coming from the West have also brought a lot of sanctions and restrictions for energy companies, which also made them divest and stop expanding. The CEO of Chevron, Mike Wirth, blames the climate change policies for the global energy crisis and puts that as the #1 cause. Wirth explained that the reality is fossil fuels is what runs the world today and it's going to run the world tomorrow, 5 years from now, 10 years from now, and even 20 years from now. Another crucial cause is of course the war in Ukraine and the sudden stop of Russia's energy exports. As you can see on the provided infographic, Russia is the third biggest oil exporting nation in the world. It has the same global market share as Saudi Arabia with a 12.2% share. The #1 oil exporting nation is the United States of America with a 18.5% market share as of the end of 2021. Although, as we are going to see in a short moment, the global share of the United States is only increased as of 2022. On the next chart, we can see another reason for the rise in energy prices, and this is the massive liquidity injections done by all major central banks around the world. More than $20 trillion were printed during 2020 and 2021, a staggering amount. Other factors include the heightened demand for energy products after COVID. A lot of people started to travel and consume more after close to a year of lockdowns. All of these factors have caused massive shifts in the global energy market, and a lot of United States companies are profiting in a tremendous fashion. All types of energy exports from the United States are skyrocketing, and more of the global market share is going to the United States. A key theme in today's world is the LNG market, which is short for liquefied natural gas. Out of the three main energy resources, oil, coal, and natural gas is the most clean and energy efficient resource. But there are a lot of places in the world where natural gas is needed, but there are no pipelines which are built there to transport it. Here comes the process called liquefaction. This is the process in which the natural gas turns from gas into liquid. LNG is natural gas that has been cooled to about -260 degrees Fahrenheit or about -162 degrees Celsius, changing it from a gas into a liquid that is 1/600 of its original volume. This dramatic reduction allows it to be shipped safely and very efficiently aboard specially designed LNG vessels. After the LNG is transported via these special ships, a process of regasification starts. Regasification refers to the conversion of LNG back to natural gas. After arriving at its destination, the LNG is warmed up and returned back to its gas state and delivered to natural gas customers through local pipelines. As Europe reduces its dependency on Russian natural gas, it drastically increases its imports of LNG, and the main beneficiary of these shifts is the United States. According to the Energy Information Administration, During the first 2 quarters of 2022, the US became the top LNG exporter in the world. The EIA report estimated that the US LNG exports averaged about 11.2 billion cubic feet per day. The daily average for the first 6 months of this year was 12% higher than in the second half of 2021. Demand from Europe, as it deals with decreased consumption from Russian natural gas, is a driving factor in the daily export levels. Europe's demand for LNG surged by 65% in the first 8 months of 2022 compared to the same period of last year. For the first time ever, the European Union imported in June of 2022 more LNG from the United States than gas via pipelines from Russia, as Moscow slashed its supply to Europe. In September, as much as 70% of all US LNG exports were headed to Europe, up from 63% in August, per Refinitiv Icon data. As Europe is looking to import even more LNG, the prices to hire an LNG ship has surged by 500% this year, as seen on the provided chart. The average price for 2019 was $92,000, for 2020 it was $65,000, for 2021 it was $90,750, and in 2022 the price skyrocketed to $374,000. And as seen on the next chart, the global demand for LNG is only set to increase until 2026, according to data from Bloomberg. From this, a lot of US companies can capitalize massively, but not only the United States LNG exports are at a record high level. Again, according to the EIA, the US has exported record amounts of petroleum products in the first half of 2022. During the first 6 months, from January to June, US petroleum product exports averaged nearly 6 million barrels per day. This was the largest first-half export in United States history, dating back to 1973. The year-over-year growth is 11%, or about 596,000 barrels of oil per day. Be sure to watch our 2 other videos about the coal and oil markets. There we go in great depth about the current and future potentials. Let's now discuss which are the main business beneficiaries and how we can profit alongside them. The biggest US energy companies are the safest bets. The bigger the company, the more stable it is and less volatile. If we decide to invest in smaller public companies, and by small I am referring to the market capitalization, we can potentially make higher returns, but the risk is also becoming much larger. The less we know, the less risk we must take on. Currently, with oil prices hovering between $90 to $100 on average over the last couple of months, the oil companies are making massive amounts of free cash flow profits. As seen on the next chart, above the price level of $60 per barrel of oil, the profits are quite massive. Another way which energy companies are categorized is as upstream, midstream, and downstream. Upstream companies are involved in the exploration and production of oil and gas. These companies are often known as E&P, which stands for exploration and production. Usually, E&P companies are often valued by their oil and gas reserves. These untapped resources are the key to their future earnings. Midstream businesses are those that are focused on transportation. They are the ones responsible for moving the extracted raw materials to refineries to process the oil and gas. Midstream companies are characterized by shipping, trucking, pipelines, and storing raw materials. Downstream businesses are the refineries and gas stations. Refineries are the companies responsible for removing impurities and converting the oil and gas to products for the general public, such as gasoline, jet fuel, heating oil, and asphalt. The safest current bets are Chevron and Exxon Mobil. These are the 2 biggest companies in the US sector. Most recently, close to today's prices, the great Warren Buffett bought in Chevron. Let's now make a quick analysis for both Chevron and Exxon Mobil. We're going to use some of Warren Buffett's favorite metrics. First, we will examine the debt-to-equity ratio. It is best for this ratio to be below 1. This would mean the equity is higher in comparison with the company debts. It is optional for this ratio to be below 0.5, or in other words, the equity to be twice the size of the debt. On the next chart, we see Chevron's debt-to-equity ratio. The information is derived from Y charts. With a current level of 0.17, Chevron has an incredibly secure debt position in relation to its equity. On the following chart, we see ExxonMobil's level, which stands at 0.26. Although higher than Chevron's levels, it is still very secure and stable. The DE ratio examines the liquidity of a company. After that, we need to analyze the efficiency of that company. For this, Warren Buffett likes to use the ROIC metric, which stands for Return on Invested Capital. Here, it is optional for the ratio to be above 10%, as 10% is the average non-inflation adjusted return of the S&P 500 index. Guru Focus gives Chevron a 17.9% ROIC, while for Exxon that metric is 22%. Both investments have excellent efficiency ratios. Last but not least, we must check the profitability ratios, and for this we check up on the PE ratio. According to Google, the current PE ratio for Chevron is 10.7, while the current PE for Exxon is 10.83. Again, very close numbers, with those of Chevron being a bit better. Over the last 5+ decades, the average PE ratio for the S&P 500 index was about 16. This means that both Chevron and Exxon currently are offering a 30% discount on their earnings to price levels. Even if the current earnings do not grow, we can achieve a close to a 10% annualized return, because a PE of 10 would mean that in 10 years the current earnings would equal the today's value of the company. On top of that, both companies offer a 3.5% dividend, which means our current potential return goes above 13%. It is important to note that Warren Buffett has chosen to invest in Chevron instead of Exxon, so for someone who needs a little help, he may lean on the greatest investor in the world. Anything that beats the S&P 500 returns over the next few years would be considered a good investment, and in the upcoming decade, according to world-renowned investors and economists, we most likely will enter a lost decade in which stock returns are anemic. This would mean that even a slightly positive year-over-year return on our investment would be considered a great result and a world-class performance. Anything above a 10% year-over-year return over the next decade would be legendary status if the predictions of the lost decade really occur. Check out our other videos about the coal and oil dynamics so that you have the full picture, and don't forget to subscribe and hit the bell icon so that you won't miss out on any future valuable content. Thank you for now, goodbye, and I'll see you later.